Welcome to episode 67 of Accessible Finance. I'm Eric Johns.
And I'm Rachel John.
Let's dive in.
All right. So, Eric, at the end of the last episode, we kind of started teased and then had to stop discussing this question from a wife. So she said that her husband is planning to retire next year.
Okay.
He's going to receive about $18,000 in his pension each year.
Okay.
She wants to know if they can contribute to their Roth for $8,000 each year. She knows they have to have at least $8,000 earned wages to do the Roth contribution, but wasn't sure if the pension could count as income. I think that there was a few words in her prompt, I think, that were off or misused, right? So we're talking about earned income, right?
Right. The reason I said it might take a while is because I thought she said conversion.
So conversion was in the initial post.
Okay.
There was a bunch of questions and clarification later on. She said, "Oh, I'm so sorry, I misspoke." So she did initially ask for Roth conversion, right? Now she's asking to see if the pension can count as income for the Roth contribution.
Got it.
End of the day, their goal is definitely to be able to contribute to a Roth.
Got it.
First of all, I guess question one, can the pension count as earned income for the Roth contribution?
No, It cannot.
So barring that, since Roth contributions are not available to them,
Okay.
right? What options do they have for being able to fund a Roth?
Roth conversion. So the idea is you can convert dollars, right? At any point in time, whether you have earned income or not, from a traditional IRA to a Roth IRA. The only restrictions are going to be if you're trying to do it within like a 401k and you're still with the employer, that kind of thing. But if you are retired or separated from service, you can typically roll your 401k into a rollover IRA, and then you can make the conversion from the rollover IRA to a Roth IRA. And some 401ks you can go straight to a Roth, but it's just saving a step. Doesn't really matter. So anyway, Roth conversions, permissible almost always. Always as long as it's your IRA. And then contributions require earned income.
Yep.
Okay, so nothing from retirement's going to count. Social Security doesn't count. Pensions don't count. Annuity income doesn't count. Interest, dividends, none of that stuff's going to count. Right? We're talking like wages, tips, commissions, things that you would, be represented on a W-2 if you were working for a company.
I think that highlights just the importance of specificity in language and the fact that income and earned income have very different meanings, and conversion versus contribution have a very different meaning.
Right.
And so oftentimes, people will ask questions and they may not get the answer they're looking for because the question that they're asking isn't conveying their intent.
Right. But no, it's a good question. The only other thing I would ask her is, I just would be clear, she's not working either, right?
I got the impression of that. That was asked. She didn't answer it on there, but
because you don't both need earned income,
correct.
But one spouse will have to have earned
great,
income to substantiate both of the
that is
contributions.
A really good. So
thank you.
If she is still working and there's earned income, right? They're married, filing jointly. It goes to the same pool on the tax return, right? So count as earned income there.
Mm-hmm.
But I definitely did get the impression, though she never explicitly said it, that once he retires, aside from Social Security, she did acknowledge she knew wasn't pension.
Got it.
The other. All right. So speaking of some retirement accounts, we have Bob. He works a full commission job. He's worked a full commission job in recent years.
Okay.
And this is the first year that he has had enough money to put something aside for retirement.
Okay.
We don't know how old Bob is.
I was about to say, how old is Bob?
Because that's a concerning thing, right? And
I think it could be 25, it could be 55, and those are very different circumstances.
We've talked with individuals who have been in that boat where they are working independent contractor jobs or commission jobs or something like that, where haven't been putting money aside for retirement. It's been kind of living paycheck to paycheck, year to year. So he says, look, I can finally put money aside for retirement. My employer does not contribute.
Got it.
So should I put money into a traditional IRA that I have rolled over from a 403B from prior employers? Okay. Or should I start something new?
Okay. He's a 1099?
Commission, I would assume.
Okay.
Yeah.
Sure. If he's a 1099, then he could start a solo plan, right? So he could.
Yeah.
This is a good question.
Yeah.
So if he were to contribute to, first, the answer is obviously it depends, as you might expect. Why? What does it depend on? It depends on his marginal effective tax rate today versus what we expect his marginal effective tax rate to be tomorrow
Mhm.
or in the future. I'm using tomorrow as a proxy for in the future, right? So, um, if he's earning relatively less than he thinks he would be in the future, or really given the fact that he's just starting to contribute to retirement, his traditional or his tax deferred balances, which is just a fancy way to say 401k, 403 plus
Yeah.
403b, 457, all those account balances that are tax deferred and IRA, traditional IRA. We want to look at that and we want to see how high that is, relatively speaking. So, like, you might be more inclined to, like, there are a variety of factors that will push or pull you towards either traditional versus Roth. Okay. So, salary's one. The less you make today versus what you think you're going to make tomorrow, right? If I think I make like 50K today and I think tomorrow, like in the future, I'm going to make 200K, then I'm more likely to contribute to a Roth today and then traditional in the future when I'm making all the extra
Tax
dollars.
bracket.
Right. So I want to pay less taxes when I'm being taxed at a higher rate. That's the whole game that we're playing here. Is just the tax rate arbitrage. We're trying to pay as much as we can at the lowest brackets that we can, or the lowest effective rate.
And to know what that is does require making some educated guesses.
Correct.
Looking forward.
Right.
But it does require knowing information that we don't necessarily have in this question.
Correct.
We do know that he contributed at some point to a retirement plan. It was a 403b that ended up getting rolled over into a traditional IRA, right?
Right.
Then he entered this commission job and hasn't, as long as he's been there, been able to contribute to
Got it.
retirement.
So we're not sure how much
We don't know
the
balances.
yeah,
or
we don't know the
anything.
balances, but we're going to assume that his balances, since he said he's just
I would
starting to
assume it's
contribute, they're
pretty
relatively low to
Yeah.
tax deferred, right? So we're not the higher your current tax deferred balance, the less likely you are to want to continue to stuff that bucket, because the higher your RMD is going to be at age 75,
Yeah.
assuming you're young, and if you're older, then it's like 73. So so that's one push and pull. And then we have to figure out, really the whole thing is going to start with cash flow. How much can he afford to divert from his take home after tax pay
Right.
to a retirement account? Right? Maybe he needs, like, maybe he's making 100 grand and he needs 60 or 70 to live on, and his tax rate's at like 25, 30%. He doesn't have a ton of wiggle room there.
And I would also say too, like when you're in, a commission industry or something where the income is volatile for you,
Mm-hmm.
it becomes super tricky to try to nail down that. And you can really only rely on past performance in history, as well as, if you have an increase of like clientele or
Yeah, that's
warm leads or things like
That's
that.
a very good point. So what you're alluding to is the fact that his emergency fund might actually need to be larger than someone else, especially if he's single and especially if he's working in a highly volatile income industry. So at least 6 months we're talking
Yeah.
here, up from the typical 3 if you've got, a married couple with
Right.
2 jobs.
And with 1099s, you're talking about typically limited benefits as well, right?
Right.
So you don't know what
He's going to be
kind
paying
of
his own health insurance probably.
exactly any kind of short-term disability that he may need,
Yeah, good
depending
point.
upon what type of commission job we're talking, right? Like he has a riskier lifestyle or the job itself is relatively risky. Likely isn't, but still, if he's out of work,
There's no
there's
income.
nothing.
Right. Exactly. So we definitely want to have that's right. We want to have short and long-term disability policies.
Yeah.
Yeah, that's a very good point. So
there's
there's
a
a
lot
lot,
to think about.
yeah, there's a lot of moving parts here, but the way we would start thinking about it is, what's your cash flow? How much can
Yeah.
we afford to do? If that number is very low, so maybe it's $7,000 or less, which is going to be the limit. I assume is he under 55
I believe so, yes.
or 50 rather?
So he wasn't looking at retirement anytime soon.
Right. So then he's going to have like a $7,000 limit in 2025 to contribute to a Roth or traditional IRA. And the income is not quite as relevant. If his income is over the traditional, well, actually, if he doesn't have he won't have a plan offered by his active employer, so he
Correct.
will always be able to take that $7,000 as a deduction on his return, even if he's making like 500K. But you may not want to. Like, he still could. There's a world where he would still want to contribute to a Roth or a backdoor Roth, which is essentially you make a non-deductible contribution to a traditional IRA and then convert it immediately, or after waiting a period of time to a Roth IRA.
I think it's important to note too that, he says this is the first year I can put money aside for retirement. It may not be. He may be thinking it is because there are other needs that have not been being met that are still needing to be met.
Right.
Like
that
an
he's not aware
emergency
of.
fund. Right.
Or like the disability policies that
Correct.
you talk about.
So it may be I did better this year than I did previous years,
Right.
which is incredible. Now, like we need to look at the needs before we look at the
Yeah.
optimizations.
So we're trying to quantify the amount of excess that he's going to have in his
Right.
annual cash flow. And if that number is very large, it depends on the level of complexity he's comfortable with in a workplace retirement plan. The two probably most viable options are going to be like a SEP, right? Which is a type of self-employed, it's a simplified employee pension. And that is going to be very flexible. You can contribute very late to that, up until I think it's like the extended tax filing deadline. I could be wrong there though. Or so a SEP is one, and a solo 401k is another. So if you have a significant amount of money that you're looking to divert into retirement accounts, you should probably consider a SEP or a SEP or a solo 401k for your business. And that'll allow you to contribute significant amount of dollars. You can probably get close to or up to the 2024 maximum was 69,000 employer plus employee, and since you're both, you can get kind of close to that. Maybe there's a limitation on the percentages that you can take, right? So in order to contribute the max, you can only do like 20% of your total revenue. So your total revenue would have to be high enough to substantiate the 69,000.
Sure.
In 2025, that limit has gone up. I don't have the table in front of me, but call it 72,000 or so would be the maximum you could divert if you had that amount of excess in your cash flow. So we're thinking either, like, if there's not a lot, we're probably just going to do a very standard IRA contribution. If you have much more than that, then we're going to look to establish a SEP
Looks like
or
it
a
got to
solo
70,
401k.
by the way.
Oh, it's only 70. Okay. I
So
thought it
might
would have
be
gone up more.
65
So
to
69 to 70.
or
All right,
something
is the
to 70.
total.
Yeah. And then yes, you're correct in the fact that the contributions can be made either by the tax filing deadline of your business or if you file an extension by the
I'm very proud of myself
You
right
should
now,
be.
guys. I just want everyone to know
I'll
that.
make you cook this
Very
later.
proud of myself.
All right. Our next question comes from somebody trying to figure out when to retire and factoring IBonds stuff. Okay, so
Oh, all right.
should I wait until retiring before cashing IBonds to pay for higher education?
What?
Our AGI is north of 350.
Okay.
It will
Congratulations.
drop to 130.
Got it.
As I understand it, the iBond waiving of taxes on income is means tested at 175K or below.
Okay.
So if I wait until I retire, I should be able to claim the tax benefit.
Okay.
I've owned these iBonds for over 20 years, so there's easily 10,000 or more of interest.
Okay.
So his question again is, should he wait to cash the I? I mean, we're talking like super min-maxing budgets here, right?
I mean, I like that. Get your annual,
So,
baby. Let's go.
uh,
Keep every penny that you can. I love it.
So, should he wait to retire to cash in those iBonds? I think it requires a lot more information of like, when are you needing to pay for this higher education?
Yeah, so just full disclosure, I am not like ultra. I mean, that's not top. iBond education exclusion is not top of mind because frankly, it's something we almost never see.
Yeah.
You're usually paying for education with 529s, or you're trying to get under the LLC, lifetime learning credit, or AOTC, American Opportunity Tax Credit. So instead of pausing and going to do the research, I'm just going to caveat with saying, like, look, I'm not ultra familiar with this. I thought that the education had to be in the education payments had to be matched with the year that you're redeeming the iBond. So I'm not sure if he's talking about going and pursuing a graduate degree at that time or like advanced, continuing well, it's not going to be continuing education, but because it wouldn't pay for that. But it would have to be qualified undergraduate institution in the United States.
Education expenses, yeah.
Yeah. So I'm not exactly certain how he's going to make that match work. It's possible that it works kind of like an HSA, where if you could substantiate the expenses, then you can pay retroactively, like, or in the future, and apply that tax credit, or I'm sorry, the tax exemption from those funds retroactively. I don't know that for a fact though. So assuming you could do that, then sure, you can wait till your income is lower and you're below the phase out. I believe that you have to match it to current year. I love that you're trying to min-max enough to actually squeeze every ounce out of this, tax savings. I like that. I can appreciate that, and I certainly relate to that.
Yeah. So yeah, I mean, you have to be over 24. And does seem that it has to be within the same year
Okay.
in order to avoid the interest exclusion. If he's talking about higher education and they're his, then presumably it's for himself,
Okay.
right? So he may be looking to do something fun for himself in retirement.
Yeah. If you want to go learn
Honestly,
and stuff, go for it,
I
man.
love the idea of retiring and then cashing them in for higher education. I would assume that if you're still working, it's probably harder to work full time and
And go and
go
pursue a
into
college degree. Yeah.
or whatever higher education. Maybe it's I don't know,
Yeah.
whatever it is that you're doing. And we talk a lot about retiring to something. So this could also have the added non-financial benefit of like
Yeah, that's a really good
having a
point.
mission or an activity.
That's a
to
really
do
good
it.
point.
So
If it's interesting and fulfilling to you, then that sounds like a great use of funds in
yeah,
retirement. I love that.
nice. Okay, perfect. All right. The last question that we'll go with today is let's see. We have someone who wrote in on the best way to pay taxes on Roth conversions with outside funds.
Okay.
Okay, so
Hmm.
this says this is my first conversion.
Okay.
In January, I planned to make a 30,000 conversion.
Can always be scary, by the way, the first conversion.
Of course.
Once you've done it, it seems
Of course.
a lot easier.
So in January, I planned to make a year-end $30,000 conversion.
Sure.
So I increased my payroll taxes all year to cover the
I see.
tax bill.
Okay.
Right?
Sure. Didn't want to deal with any timing penalties. I like it.
Correct.
Well done.
So
Smart.
taxes on 30,000 conversion covered.
Okay.
But now I want to make it a larger conversion.
Got it.
I'm looking at 80,000.
Great.
If I just pay the additional 11,000 in taxes to the IRS online now, what issues am I with
None.
and why?
Because you're matching the timing of the additional realization of income to the tax payment. So you only have to pay by the end of the quarter. Boy, I wish I would have known these. They're dates, right? So the quarter 4 is January 15th of the next year. I can't remember all of them offhand, right? I should. I want to say it's like April 15th.
Yep.
They're April 15th, June 15th, September 15th, and then January 15th, right?
Mhm.
So it's not exactly every 3 months as you might
Now,
expect.
the April to June one is weird because there's only 1 month in between instead of 2.
2 months, right? April 15th to June.
Well, but I'm saying that it's only May. Like May is the only month that is in
Got
between those rather than having 2 in between.
Got it.
Because
And then September and January is long,
yes.
right?
that
So
one's better.
yeah, you just want to be mindful of that. As long as you're paying that estimated payment by the end of those due dates, by the
quarters.
due dates that are for those specific quarters, right? With quarter 1 being April 15th and quarter 2 being June, etc., then you're good to go. All right. So as long as you pay your tax on the incremental tax on the 50K by the end of the quarter that you did, right? Then you're good. Then you're all set. That's that's smart. That's the way to do it.
And
I
I
like
think that's what's well. And first of all, I think that
and the withholding, adjusting the withholding to preempt the initial conversion is brilliant and not something that a lot of people do. But you can adjust your W-4 at will, so you can do that multiple times a year. There's no restriction on it. So as soon as you're looking to estimate your taxes and you're realizing, oh wait, I'm over or underpaying, you can just go and over withhold or like add additional withholdings or reduce your withholdings based on what you expect your tax.
Or we increase withholdings on the beginning part of the year, or we meet later in the year and realize we need to increase withholdings in the last 3 months.
Sure.
But I think I think that the main takeaway here is the fact that the 80,000 conversion is not happening until quarter 4, right?
Correct.
So then the taxes, I mean, he was like, I got the 11,000. I'm ready to go on the website and pay it. It's done in the same quarter that conversion's taking place. You're good.
Right. Importantly, though, you don't want to wait until April 15th to pay, because if you did, you would be late.
Yeah.
Right.
And that
because your payment was due January 15th because you realized the income in quarter 4.
And that's a great point, because I think so many things, everyone's like, okay, April 15th is the tax day. That's when I can pay all my taxes. That's when
right. Not quite the case. Also, if you find yourself in a position where you maybe made the Roth, maybe let's assume that we did 30 plus 50. Let's assume we did the 80K in quarter 1
in January,
and we made no adjustments and made no estimated payments. And you find yourself maybe mid-year, maybe even 3rd or 4th quarter, and you're like, wait, this isn't good.
Yikes,
like I'm going to have a huge tax bill and I missed it. what can you do?
That's a good
You
question.
can withhold from you can adjust your W-4 to make it to where you're withholding almost 100% of your W-2 earnings until you've satisfied that tax liability. Or like, you could do the math, right? Like if I have 6 pay periods left in the year
Yeah.
and I'm going to owe 60,000,
Yeah.
now I'm going to have 10,000 per pay period that I'm withholding, assuming I make 10,000. Also, there are a couple nifty tricks. One of them I wouldn't actually advocate you DIY because it's interesting. And there's a couple. So one is you can, if you're going to take a withdrawal from a retirement account and you're qualified to do so, you can do so and withhold all of it for taxes. Note that you will incur ordinary income tax or a penalty if you do this, right? If you're under 59 and a half. Okay, so if it's not a qualified distribution, you'll owe a penalty. But some people have RMDs and they might make
if you're taking it anyway.
right. Then you can withhold, like 99.9% of your RMD straight to the federal government.
So like in this situation, 11,000.
Yeah, that was the marginal on the 50, right?
Correct.
So let's assume
they
it's
already
like
paid for the 30, right? So this person owes 11,000.
Yeah.
Let's say that they did the 80 conversion in January rather than in November, right?
Yeah. We could take an RMD of like 11,000
Yeah.
and withhold all of it and send it straight to the federal government.
Okay.
And probably send some to the state government as well if you're in a state that has annual income tax.
Okay, perfect. So then would that prevent penalties?
Yes, 100%. So if you have withholdings from distributions, either from from a retirement account, or if you have any kind of withholding, so either W-4 withholdings or withholdings from a distribution from a retirement account, those are considered contributed and paid on January 1st of the year they were withheld.
Right.
So even if I withhold everything from an RMD that I take on December 31st, 2024, it's treated as if I paid the government on January 1, 2024.
And so exactly. So as long as you are aware of the fact and catch your mistake before the end of the year, then there are things that you can do
make
to
up for
kind
it.
of retroactively. Now, going on the IRS website, like this person was saying, can I just go on the government website and pay it? That's not going to prevent the penalty from happening.
Correct.
Because that'll happen and be active as of the date that you make that payment.
It's going to be in that quarter, right? We
Correct.
said the deadline in the quarter, so it's going to be,
In
if
the
you
fourth
pay it,
quarter.
if you pay it September 1, then it's going to count in quarter 3, right? Because September
Right.
15th was that quarter deadline.
Right. And here, this post was made in November, right? So this person is looking to up from the 30,000 that was covered to the 80. So they certainly have time, and if they went on the website to pay it,
Yeah, they could do it by January 15th, and they're set.
But if they had made it in January, and then they went on the website to pay it, there are penalties. Whereas,
No, you're good. I'm excited to talk about the last strategy that.
Okay, tell me.
All right, so we call this podcast Accessible Finance, and we're trying, I promise, to make it accessible to every listener. The other strategy that you can pursue that's quite clever is you can make you can take your distribution from your retirement account. Let's assume that I do it. I'm not 59 and a half yet.
Right.
So I would be paying penalties on this distribution.
Correct.
So I can take you can only do it once a year, right? But I can take I can make a qualified 60-day rollover and have withholding from my qualified 60-day rollover as long as I deposit the full amount that I withdrew back into the account before that 60-day period ends. So I can actually take a distribution from my simple IRA or traditional IRA or whatever, withhold all the taxes. Maybe I owe $20K in taxes that I know is going to be an underpayment because I made a huge Roth conversion early in the year, and now it's Q4. And if I just made the payment if I paid $30,000, I think I said $30,000. If I paid $30,000, wrote a check directly to the IRS, they would hit me with penalties.
Yeah.
I mean, they would hit me with interest on the shortfall, right? So what I can do is I can take a distribution from my retirement account of $30,000, withhold all of it to the IRS.
Got it.
Okay. And then deposit from my checking account $30,000 right back into my IRA. And as long as it's within that 60-day period, I pulled one over on them. I've avoided it, guys. That's a strategy. Please don't try it yourself. It's dangerous.
But if you have the 30,000 instead of so I have 30,000 in my bank account, I have 30,000 in my retirement account. If I go onto the website and put 30,000 from my bank account onto the IRS, I am penalized, or I'm hit with that interest, right? If instead I take 30,000 from my retirement account and withhold it as taxes, that goes and pays the bill. Then I take the 30,000 I was going to pay the IRS with from my bank account and instead put it back into my retirement account. So as long as the money's coming from the right hand instead of the left hand, good. Okay.
Perfectly explained. Pretty clever, huh?
Nice.
It's pretty crafty.
Again,
when I heard about that one, I was pretty pleased.
To ensure that the replenishment of that retirement account happens in a timely manner to avoid a second set of issues, you definitely want to be very, very sure or work with a.
It is dangerous.
So,
because you will get hit with 10% penalty or $3,000.
That's something that
And
we would
yeah,
advocate
and
helping.
ordinary income
So.
tax on the whole amount. So
All
not
right.
great,
Okay, clever.
not great, but pretty crafty.
Very nice.
Pretty
All
crafty.
right. Well, that wraps up today's episode. Tune in next week to hear some more questions.
Love it. All right, thanks guys.
Till next time.